let's go to scarcity. I'm going to keep referring to scarcity a lot. And that's because it's an underpinning concept in economics. It is the number one rule in economics, and it's literally the reason why economics even exists. So scarcity is basically when we have all these unlimited wants. So all these unlimited wants and needs, and we have a limited amount of resources such as land, labor, or capital to satisfy these wants and needs. And because of that, we're really forced to make decisions on how we want to allocate our resources. And that brings us to budgetary policy. So even the government has a budget. So it has these limited funds that it can allocate to different areas. So for example, there's healthcare, education, defense, and so on. So if the government decides to allocate more money to education, there's an opportunity cost. It's losing out. So there's another industry, another area that's losing out on the funding. So that brings us to actual relative scarcity. So let's talk about budgetary policy. So that's what Unit 4 is basically all about. So it's all about how the government uses its power to really change the economic outcomes. So to achieve our economic goals, we're going to go through that today. And also about how it uses indicators of the economy, so like demand, supply, and so on, to create some policies, to create some goals, to, achieve our goals. Okay, so government policy. So you've got fiscal policy, you've got monetary policy. Another word for fiscal policy is budgetary policy. So budgetary policy is all about taxes and spending. So it's about how much tax the government collects, and then as opposed to that, how much they spend and how they spend those receipts. So quick note, taxes, they're called receipts. Spending, they're called outlays. And then monetary policy, that's all about the RBA, so the Reserve Bank of Australia. It's about how they set an interest rate, or cash rate is a better word. They set the cash rate, and based on that, they alter the supply of money in financial institutions, so stuff like banks. They affect interest rates in the end, so ability of people to borrow, save, and so on. A bit of background information. So budgetary policy, it's basically a tool that the government uses to work with monetary policy. And every year the Treasurer announces it in May. So this year's budget I think it's definitely released because it's June now. So it's announced by the Treasurer every May, except 2019 and 20. So stuff happened then. So obviously they delayed it a little bit. The actual outcomes of the budget, those are released in the mid-year economic and financial outlook, so that's also something to look out for. I don't think it's been released yet. And the goal of budgetary policy is to overcome situations in order to achieve our key economic goals. So we want to first overcome whatever's going on in the economy. So that was a really big deal in 2020 with the pandemic. We want to achieve our economic goals, so strong and sustainable economic growth, full employment, low inflation. And we also want to achieve a surplus. So this is not as big of a deal because if there is a need to spend, the government will spend. And then, so we just want a surplus on average over the medium term. So that's sort of a secondary goal. Okay, and since the global financial crisis, it's a really important tool to, influence our economic performance, so change the levels of demand in the economy. This is literally copied and pasted from the budget, so from the Parliament website. And some of the medium-term goals are first, so you want to reduce debt. You want to try to achieve a budget balance. So we'll talk about what that is a little bit later on. We want to make sure that, our revenue grows. So that we have policies that, increase our earnings, increase the economic growth, and so on. And we want to maintain our tax burden. So we don't want it to be too high, but we don't want it to be too low either. So those are just some of the strategies. So you can have a look at it. You can visit the website as well if you're interested. But this is the more important part. So our domestic goals. So domestic goals, so those are, I guess, the goals that the government is trying to achieve. And you need to be able to identify each goal, so each of those 3 goals, define them, and explain how different policies have an impact on each of the goals. Okay, so we've got strong and sustainable economic growth, price stability, and full employment. And those are our 3 goals that the government tries to achieve. So strong and sustainable growth. So we want real GDP or gross domestic product. So real GDP is fine. And we want it to increase by 3 to 4% per annum. Next, price stability or low inflation. So they're both the same goal. We want CPI or Consumer Price Index to increase at 2 to 3% per annum. And we really want those keywords on average over time. So that's definitely a keyword to include. Lastly, full employment. So that's when we want non-accelerating inflation rate of unemployment. So basically, we want a rate of unemployment that doesn't cause excessive inflation. So that's at 4 to 5%. Okay, so aggregate demand, this is a bit of a revisit. It's made up of 5 parts. So consumption, investment, government demand, and exports. So those all increase our aggregate demand. And then imports take away from the aggregate demand. So so basically when we're talking about the effects of the goals and the effects on demand, we want to say which of these parts of aggregate demand that it's actually affecting before we say, well, this increased aggregate demand. So for example, if I say, well, if the tax rate is higher, I would have to say, how does this affect consumption? So it would mainly affect your consumption. It doesn't have much of an effect on exports or imports, maybe not even investment, mainly consumption. So you would say how it would affect consumption, and then as a result, it would affect aggregate demand in this way. So make sure you talk about the parts of aggregate demand that are increasing as a result. Then aggregate demand increases. So hopefully that makes sense. Okay, so our first goal of strong and sustainable economic growth, and the goal is to achieve a rate of 3 to 4% growth in real GDP per annum, and over time without causing inflationary pressures. So you can have this goal literally memorized verbatim, and you would get marks on the exam for the definition. Again, obviously you want to make sense of it, so you want to say real GDP, that's a keyword, per annum. So this is the growth you want in real GDP every year, and without the inflationary pressure, so without causing excessive inflation. And real GDP, so a quick refresher, is basically a measure of the total production in the economy, so the volume of production. Okay, how does a budget actually affect growth? So if you have an expansionary budget, so for example, budget that spends a lot more than the receipts, so spends a lot more than there is, they tend to increase aggregate demand. So increased spending by the government, as a general rule, increases our aggregate demand. But at the same time, those expansionary budgets might also cause a budget deficit, and it could also cause debt. So we'll talk about that a bit later on. So for example, let's talk about tax cuts. So tax cuts means that in general, people don't have to pay as much tax. So if people aren't paying as much tax, that means the government does not get as many receipts. So it doesn't get as much tax money. So it has less to spend now. And because it has less to spend, so the government has less to spend, but in the meantime, people, after paying tax, they're now left with more money. So this money they can spend in the economy. So there's a higher consumption spending, which results in an increase in aggregate demand. Another thing that we can talk about is, stimulus payments. So that's a really easy one to talk about. So if the government gives payments to people, so for example, payments to people who, I guess, want to take further study, and the government gives them payments. This payment means that they'll be able to take that study, they will be able to do that, but at the same time, they'll still have money remaining so that they can spend in the economy, so like consumption. Same with businesses, so stimulus payments for businesses. So if there's some small businesses that are struggling, if they get that stimulus payment, it means that they'll be able to use that payment to invest and do all of that. So this increases our investment spending, and thus we'll get a higher aggregate demand. Slide there, it should be unemployed divided by labor force, and the labor force is made up of employed plus unemployed people. Full employment, so our goal is to achieve an unemployment rate of 45%. So we don't want too much, we don't want too little. And if we have an expansionary budget, so a budget that's designed to increase aggregate demand, then it could help decrease our unemployment. And that's because, let's say people are spending a lot more, there's higher aggregate demand. That means there's a higher demand for goods and services. And if there's a higher demand, producers now want to meet that demand by producing more goods and services. And to do that, they need more resources. And one of those resources is labor. So they need they need to hire people to fill the labor resources that they actually need. So it could decrease unemployment if there's an expansionary budget. Let's see. Oh, okay, here's the graph of unemployment. A bit of a note to make here. So the heading of the graph is labor underutilization rates. It's not the unemployment rate. So the unemployment rate is here in blue, and you can see that it's been relatively constant recently. Actually, it's been really high, probably around 2020. So it's really peaked at about maybe even 7 or 8%. So it's a pretty high unemployment rate. But then it's fallen, and now it seems to be around 3 to 4%. So just below our goal. But you can see that it's been fluctuating. There's a huge drop in unemployment rate between, let's say, 2020 and 2023. Another thing to keep note of is the underutilization and underemployment rate. So let's talk about underemployment rate first. So underemployment is you're classified as unemployed, but you're not really working to your full capacity. So let's say you work 1 hour a week and you want to work 30 hours a week. That means you are underemployed. So you want to work more hours, but you're not given the opportunity to. Underutilization, so that's unemployment and underemployment together. So people who are fully unemployed, not working at all, and people who are working less hours than they would have liked to. Okay, so let's move on to low inflation now. So the goal of low inflation is to achieve a rate of inflation between 2 to 3% per year. And it's measured by CPI, and it's on average over time. So that's really, really important, that on average over time or over the business cycle, that part is super, super important. And the reason for that is when we measure inflation, we're not just looking at a sudden spike in it or looking at it over a month or something. We're looking at it over a period of time. So we want to make sure that in our definition, we're including that. So make sure at the very end of your definition, you include the on average over time here. Okay, so next we have demand pull inflation, and that's basically inflation that happens because aggregate demand is increasing, and it's increasing so fast that aggregate supply cannot keep up anymore. So that's pretty common. That's one of the most common reasons why inflation does occur. There's also cost push inflation, and that happens when aggregate supply shifts to the left, and there's suddenly a shortage of resources and prices just increase really quickly. So demand pull caused by shifts in demand, cost push caused by shifts in supply. And usually supply shifts if we decrease our productive capacity. So an example of why cost push inflation could occur is if there was, a natural disaster that wiped out a lot of our industries. And then we had shortages, and that would cause cost push inflation. Okay, so let's talk more about low inflation. So let's say we had an expansionary budget. It means you're stimulating aggregate demand, you want more and more spending. That would also cause maybe shortages. That would shift aggregate demand to the right. And that could result in shortages, it could result in prices increasing. So when we have expansionary budgets, as a general rule, it will also lead to higher inflation. If we have a contractionary budget, as a general rule, it could lead to lower inflation because of lower aggregate demand. So aggregate demand shifts left, you have less demand pull inflation. Okay, supply side, so we've got aggregate supply policies. So for example, let's say the government decided to give stimulus packages or tax cuts to businesses. That means that, now it's cheaper to produce, now they're more able to produce and more willing to produce, and that would increase the aggregate supply. So that would decrease inflation because a higher aggregate supply means that we have less cost push inflation, and that would decrease our overall levels of inflation. Okay, so here's a graph of our CPI. So you can see here, the purple graph is probably the most relevant. If you see an odd part of the graph, most likely it happened in 2020. So here we've got inflation, and that's basically, negative. So we've got deflation going on there. And that could be due to how there was all those lockdowns, all those businesses closing during the pandemic. But on the right here, there's a spike in inflation. So right now, inflation is super, super high. It's well above our goal. So while our goal is from 2 to 3%, so we want our inflation to be around 2 to 3%. Currently, inflation sits at around 7%. So super, super, super high. Okay, so let's talk more about the components of the budget before we talk about the different policies. So receipts and expenditure. So basically, the government's revenue or its receipts come from these three things. So it can come from direct taxes, so taxes that are directly on personal income. So that's where most of the receipts come from. So personal income taxes. There's also company tax. So when companies make profits, they also get taxed on their profits. Capital gains tax. So that's basically when you make a profit for selling your assets. So when people sell a house, they often have to pay a tax, which is called the capital gains tax. There's also indirect taxes that a lot of people have to pay, and these are added. So these are not on your income. These are basically levied on your spending. So they're basically added to the price of goods and services. So an example, GST, really big one. That's when you have to pay 10% extra. Excise taxes. So for example, when you buy tobacco or petrol or alcohol, there's actually an extra tax that you're paying, and that's why it's really expensive. There's also non-tax revenue that make up receipts. So, for example, if the government makes a profit, so let's say Australia Post makes a profit, that's non-tax revenue going to the government. If the government decides to sell its assets, so for example, let's say it decides to sell the Parliament House, that's non-tax revenue. HECS interest rates, so all the students paying their loans who have to pay interest on top of it, extra money for the government, and so on. A bit of taxation vocab. So tax mix is the balance between direct and indirect taxes in your revenue, and it's your mix between direct and indirect taxes. Tax base. How broadly the source of government income spans. So basically, where is that government income? Where's the revenue coming from? I haven't really seen tax base come up at all, but I guess it's good to know. There are a few principles of taxation. You don't need to know this, but just for your interest, so you want taxation to be easy to understand, that we want it to be equitable, and we want it to be efficient. So we want to make sure that the way people tax still maximizes efficient resource allocation. So here's an overview of tax over the years. You do not have to remember this at all. This is, again, just for your interest. And you can just see that the majority of the tax in almost every year is coming from household income tax. So that is personal income tax on households. Next, there's corporate income tax, so that's like businesses. And other, so other could be any other ones. So like excise taxes and so on. Your budget over time, so here is the government's budget over time. You can see here it's 0, and anything below 0 means that we have a deficit, so it's negative. And you can see a really, really big negative, here. So there's a huge negative in the budget here, but it's expected to improve over time. So you can check out how the budget's going using the source here. So there's a link here that will take you to the website. Okay, so sources of our revenue. So your revenue can come from all these different sources. Mainly, it's coming from individuals, so people who are paying income tax. But it can also come from, let's say, company tax or GST and so on. But again, you don't have to memorize it. Just know that income tax makes the highest revenue. Outlays, so these are our expenses. So this is what the government is spending on. So you can see the main expense is revenue for states and territories. So you have the federal budget, and it's distributed. So there's some of it that's distributed among the states and territories, so they can do, their own thing. So like your local council, Victorian Parliament, and so on. Another one, so support for seniors. So that could include stuff like pension, and yeah, I think it would mainly be pension, and so on. So you can see where a lot of the budget is going. And you can see a lot of it is actually for welfare. So support for seniors, NDIS, aged care services, so on. They would mainly be for welfare. So you can see that that's where most of the budget is going. Okay, so this is a more recent snapshot, and it tells you where the revenue is coming from. And you can see, again, individuals' income tax, that makes the biggest proportion of our budget. Okay, and then outlays. So this is actually this year's budget. And you can see that Social Security and welfare makes up the biggest proportion of our spending. Okay, so now let's move on to the different types of taxation. So yes, people get taxed, and that makes up our receipts for the budget. But there's actually a lot of different types of taxes that a lot of different ways that people can get taxed. So the way that we do it in Australia is we have the progressive income tax, and that's basically a certain as your income increases, you pay a greater proportion of your income as tax. So it's basically the more you earn, the more percentage you pay. So it's a higher rate of tax. We also have proportional income tax, so that's when everyone pays the same rate of tax. So that's on income or profits. And then we also have a regressive tax. So this is same rate, and it's almost like people who are earning less are paying a greater proportion of their income as tax. And an example of that is actually GST. So because it's on spending, and let's say someone buys something for $10, they pay $1 in GST. Okay, and we have one person who only earns $100 a week and another person who earns $1,000 a week. The poorer person will be spending 1% of their income as GST, whereas the richer person would be spending 0.1% of their income as part of their GST. So you can see that if you earn less, it's actually a higher percentage of your income. Government expenditure, so that's basically where the government can spend its money. So you've got current expenditure or consumption expenditure, and that's basically spending to sort of, maintain the day-to-day functions. So have your everyday operations of the government going. So for example, you've got paying wages, paying salaries to government employees, other things, so buying stuff like stationery or paper, stuff like that, which is just current. So you use it, you can't use it in the future. Next, we've got our capital expenditure. So capital expenditure is when you spend on stuff such as like infrastructure or assets, and these are supposed to have better outcomes for the future. So they're supposed to grow our productive capacity, they're supposed to make conditions of the economy much more favorable. So an example of capital expenditure could be, infrastructure. So if you're like building a new school, if you're building a new hospital, you're building better roads so that, it's easier to transport goods and services from across Australia, that's capital. And just a key note, transfer payments, so that's like welfare. So welfare, goes directly to your bank account. They don't form a part of government expenditure. So they don't form a part of government expenditure in aggregate demand. And that's because they're recorded when people spend that money. So let's say I was receiving welfare, and let's say I received $100 a week. That's not going to go as part of government expenditure. When I go ahead and spend that $100, it will be recorded as consumption spending. So just something to keep a note of. Budget outcomes, so this is basically when the government, spends its money, has the outlays, has the receipts, has everything. It's basically how the budget's looking after that. So your outcome can be a surplus, so that's when your receipts are greater than expenses, so you have more revenue than your outlays. You've got a budget balance when your receipts are the same as your expenses, And then you've got a budget deficit, which is most common for us, where our receipts are less than our expenses. And our budget outcomes, they're calculated using two approaches. So you can use the cash approach or actual approach. Again, this is not the most, it's not super important for 3-4 Echo. But for your interest, cash approach, so that's basically the value of receipts and outlays after the government actually receives or pays out the money. Actual approach, so that's basically when all those expenses and revenues, you show them as they're actually happening. But again, this is not super relevant to Echo, so you don't need this for the exam. Budget reporting measures. So they're specific measures that we can take note of to report our budget. So we've got a headline balance, which is our total cash value of budget receipts. So we've got total outlays, and so basically receipts minus outlays is what it's saying. And it doesn't remove once-off events. So for example, if the government sells Australia Post, it's still included in the headline balance. But the underlying balance, it sort of shows us, it gives us a good indication of the government's financial situation. So this is situation over time. And it's basically when you calculate your headline balance, but then you get rid of any of the volatile when you get rid of any of the volatile events. So for example, let's say you got the sale of Australia Post, and you remove that because it's a once-off thing. So once the government sells an asset, they can't sell it again next year because it's not theirs anymore. Okay, so cash versus accrual accounting. So we talked about this earlier. Cash, it's the value of receipts and outlays only when the government actually gets those receipts or when they actually pay out those outlays. Accrual is as they're incurred, so expenses as they happen, and revenues as they're earned. So basically, it's more, I guess, current, you could say. Okay, that's it for the budget. Let's talk about other parts of the budget. So future fund isn't something that's discussed a lot. Again, it's not a really big thing in Echo, but it's basically, I guess, an investment by the government, and it's to try to make sure that there are benefits that the future generations could have. So it doesn't really affect the budget outcome. It's not a really big part of it. But for example, if you look here, copied and pasted directly from the Parliament website. So like, for example, medical research future fund, that's investment to generate money over time for, let's say, medical research. So it's not a huge part of Echo there. This part here is definitely an important part. So surplus, deficits, and budgetary stance. Okay, so what is the policy stance? So the budget stance is basically whether it's expansionary or if it's contractionary. So let's say the budget is in deficit. That means it's expansionary. So it's basically trying to increase aggregate demand, trying to increase the levels of demand in the economy. So it basically means that the government is spending more than it receives in receipts. If the budget is in deficit, but let's say the deficit is smaller than what it was last year, that means that it's still expansionary, just less expansionary than last year. If we have a budget surplus, that means that the budget is contractionary, and so that means that, the levels of aggregate demand is supposed to decrease. So the aim is to decrease the levels of demand in the economy. But lastly, if the budget is in surplus, but it's decreasing in size, so let's say the surplus is smaller than last year, that means it should say less contractionary here. So if the budget is in surplus, but decreasing in size, it's actually less contractionary. Okay, and there's a lot of things that could impact your budget stance. So it can be impacted by automatic stabilizers, which is really important. It's an important concept, and we'll get onto that in the next slide. And it will also be impacted by the crowding out effect. So that's a bit of a new concept, and that's also something we'll discuss in just a bit. Okay, so let's go to the next slide. So this is about automatic stabilizers. So it's basically when, let's say you have high growth level, right? If growth levels are high, automatic stabilizers means that there are less outlays, so less welfare that you pay, more receipts from personal income tax, and then there's a less deficit or a higher surplus. Okay, so basically, before we look at examples and anything, the meaning of automatic stabilizers is without the government doing any deliberate action to change the budget automatically changes due to the levels of demand, supply in the economy. So due to the levels of growth in the economy. So let's look at an example now. So let's say, let's look at 2020, for example. That's a great example to look at. So during 2020, we even had negative levels of growth. So we had very, very weak growth. And without the government actually putting down any policies, without them actually taking deliberate actions, we still got a budget deficit. And the reason for that is, so we had low growth. That means usually if we have low growth, it means unemployment is quite high. So we had a lot of people unemployed in 2020. We had a lot of businesses struggling because there was very little demand. So because of that, firstly, there's less income tax paid to the government because more people are unemployed, so less people are paying that income tax. So automatically decrease your receipts. Next, you've got those companies struggling, those businesses struggling to make profits. So automatically, again, you've got a decrease in the company tax that's paid to the government. So you can see how automatically, without the government taking any deliberate actions, the budget can decrease when there is less growth. So there will be a higher deficit. It will be automatically expansionary when there is less growth. On the other hand, you have discretionary stabilizers. So discretionary stabilizers is when the government so it makes a deliberate change to the budgetary policy. So for example, let's look at 2020 again. In addition to those automatic stabilizers, the government decided to introduce a new welfare payment. So JobKeeper. So JobKeeper was definitely a new one. So if you lost your job, you could earn this much because of, you lost your job because of lockdown. So all of those, they affect the budget. So the levels of growth in the economy does affect the budget automatically, and when the government makes a change due to discretionary stabilizers. Okay, so let's talk about discretionary stabilizers in a little bit more detail. So discretionary stabilizers are deliberate changes. So when the government makes very deliberate changes to your tax rates, the tax mix, the composition of your budget outlays. So another word for discretionary stabilizers are structural stabilizers or structural factors impacting the budget. Okay, so government usually employs a counter-cyclical budgetary policy. So that means that usually if there's a lot of growth, if there's a lot of economic expansion, we have a contractionary stance. So we want to try to keep growth, but we want to keep it stable so that inflation isn't excessive, it's not unsustainable. In the same way, if there's an economic contraction, so let's say the economy isn't doing that well, so there's low levels of growth, things aren't going that great. Then we take on an expansionary stance and try to achieve strong and sustainable economic growth. And this will actually help us stabilize that economic activity. So it will help us stabilize the level of economic activity. Okay, so a surplus, it can be expansionary. So, and the reason for that is it's more of a long-term effect. So let's say the government decides, well, we'll have a surplus and our aim is to be contractionary. But in the long term, it can actually have the opposite effect. It can be expansionary. And the reason for that is, so the government becomes a net lender of money. So if we have a surplus, it means that the government tends to lend money to other places, so other institutions, right? So instead of being a net borrower, it's a net lender. So this means that there's less pressure on financial markets. So basically banks, financial institutions, they have a lot more money to give out in loans and so on. So if it can give out loans, if it's more easier for people to get loans or borrow money, that results in crowding in. So crowding in means that we have less interest rates because, financial institutions now have more liquidity, so more, money to give out. So less interest rates, and there's less demand for money because the government isn't borrowing that money anymore. So this increases our consumption because if consumers are more able to get loans, they're more likely to spend. So it also decreases investment. So if you're able to get a loan or invest in a bank, so it increases investment. And it also increases our level of aggregate demand, GDP. So it can be expansionary. So that's sort of what I'm trying to get at here. At the same time, if you have a deficit, it can actually be contractionary. So in the long term, it can cause crowding out. So crowding out of the private sector means that because the government is borrowing money from those financial institutions, so it's borrowing all this money, and that means there's less money available for the public to use. So this can actually result in crowding out. And this causes a higher interest rate and it reduces our consumption spending because it's harder to borrow money, there's more repayments, reduces investment, reduces aggregate demand, reduces growth. So essentially, that's what they are. So a quick summary of crowding in and crowding out. Okay, so we talked about crowding in, crowding out. But now let's talk about deficits. So it's all well and good when the government has a deficit, is spending more, and is trying to be expansionary. But then a deficit is literally a negative account in the budget balance. So it means that we are spending more than we're actually getting in receipts. So how does the government actually make up for that negative balance? How does the government spend more than it receives? So there's a few ways that the government finances deficits. So way number one, it can sell government bonds to overseas creditors. So basically borrow money from overseas. If it does that, it basically could, so it could cause an appreciation of the Australian dollar. That could also reduce our exports and aggregate demand. Why does it cause an appreciation of the Australian dollar? It's because when you borrow money from overseas, you're converting the foreign currency into AUD, and that means that you have a greater demand for your Australian dollar, and that increases, the price, you could say, of the Australian dollar. Next, sale of government bonds to Australian financial sector, so borrowing from local banks, local financial institutions. And that's what causes crowding out. So we talked about crowding out earlier. It's when now the private sector and the public sector, so private and government, compete for limited credit. So this means that interest rates can increase, there's less credit in banks that people can borrow, and it can actually, in the long term, reduce consumption and investment spending. Okay, next. Sale of treasury notes. This is definitely not something that they really do. And it's basically equivalent to printing money. So you just print lots and lots of money, and then it starts to lose its value. And then because it starts to lose its value, you need more money to buy different things. And that can have an inflationary effect. So this one, definitely not used very often, at all. Able to distinguish between debt that is good and debt that is, bad. So good debt is usually classified as something that's because of capital expenditure. So basically stuff like infrastructure, things that give you an ongoing benefit. So even in future or even returns on your investment. Capital spending is an example of good debt. So capital spending like infrastructure, better roads to improve supply, and so on. Bad debt is debt that you get from current expenditure. So current expenditure such as government salaries, so salaries for employees. It's a once-off thing. It doesn't really provide any future benefit. Another example of bad debt could be like once-off costs for the government. So stuff like, I can't think of anything except employees at this moment, except salaries, but it's just sort of once off and it doesn't give you any benefit in the future. So credit rating is basically it tells you how able a government is to pay back debt. So if so we have to pay back principal and we have to pay back our interest, right? And if the government, for some reason, doesn't pay either of them, it means that economies wouldn't be as willing to loan. So, for example, let's say the Australian government wasn't able to pay back the debt, right? In the future, if the government wants to take an expansionary stance and have a budget deficit, it wouldn't be able to because it would be unlikely that other economies would lend it. So, unlikely that other economies would lend that money. So that's where the credit rating comes from. So we currently have a AAA rating, which is the best rating, right? But if we weren't able to pay that debt or if we weren't able to finance all those loans that we have, that rating might actually drop. And if we have a lower rating, it means that we're charged higher interest rates and that makes it harder to borrow. And it might also make different economies unwilling to lend to Australia. Okay, so now let's talk about surpluses. So we talked about deficits, how they can lead to debt. Now surpluses, there are many different ways that the government can use a surplus. So it can use it to repay the debt. So overall, so it uses a surplus to repay the debt, reduces your net foreign debt, and it can increase that external stability, so because we are paying off our debt. But this can lead to crowding in, so it reduces the cost of credit because it's paying back the money. There's more credit available for the private sector. Another thing it can do is it can save with the RBA. So it's basically government savings, and it's just you can finance a debt or you can just save it, and it makes your investors, so people giving you the debt, more confident in you because you have those savings now. It can add to investment balances, so for example the future fund, and try to get returns in the future. Or it can, again, expenditure, so it can use that surplus to provide goods and services. Okay, so fiscal policy does have some weaknesses, and the main weaknesses are the first two here, so long time lag and constraints. So those are the two very main weaknesses. Definitely long time lag, that's definitely easy to talk about. So what long time lag means is, let's say the government decides to implement a policy, right? It has to pass through all those levels of parliament. It has to, and it takes a long time for that to happen. So it can take years and years for a policy to pass. And because of that, so let's say the government is doing badly and the government wants to introduce a new welfare payment. It could actually take years for that to happen. And by that time, the economy is doing well again. So long time lag. Another weakness is constraints because of conflicting stability and other economic goals. So what that means is if we have contractionary budgetary policy, there's low inflation, yes, so we want to lower inflation, and it increases our external stability, right? But at the same time, it also decreases our growth. Expansionary, it increases employment, it leads to strong and sustainable growth, but it can actually hurt our inflation and external stability. So you can see how they're conflicting. A political constraint, so that's pretty easy. That's basically because of the politics. So different politicians have different ideas, different parties have different ideas on how to spend and so on. And that's a political constraint. And psychological constraint. So consumer and business confidence might undermine the policy. So let's say the government does give out welfare payments, it introduces tax cuts and all of that. If the consumers are still very, very, if they have very, very low confidence in the economy, they're still not going to spend it regardless of that. So it's kind of not going to affect the economy unless the consumers decides to go and actually spend that money. Some of the budget knowledge that we need to know. So in your exam and in your SACs, you would have to know some of the main policies in the budgets and how they affect our goals. So you need to know 3 different budgets. I think the 2022 to 23 and 23 to 24 is actually enough. But if you really want to solidify it, you can also do the 21 to 22. So these are the budgets from, I guess, the past 2 years. And pay special attention to this year's budget. Okay, so let's look at the current trends first. So you need to be aware of what trends there are so you can link them to the different aspects of the budget initiatives. So look at growth. So we've looked at these graphs before, so just putting them all together. So growth is, it was super high at some point, then it fell a little bit. CPI, so that's inflation, really, really high right now. Labor underutilization rate, so unemployment I think it's sitting within our goal, around our goal. So you can see what's happening right now, and you just need to know sort of the trend. So is it within our goal or is it not within our goal? Okay, so that's where budgetary policies come into place. So in 2022 to 23, these are some of the policies. I'm just going to list them out, and we'll link them to demand, supply, and so on. We'll link them to the goals more specifically. So let's look at the one-off cost of living tax offset. So it's basically a tax offset. So it's basically less tax. So these people can pay less tax. So what goal would this affect? This would affect strong and sustainable economic growth because people have more money to spend. That's a main one. I think it's more linked to, yes, so strongly linked to strong and sustainable economic growth. Temporary fuel excise relief. This one would also affect strong and sustainable economic growth because consumers don't have to spend as much on fuel, so they might spend their money elsewhere. So usually fuel is an import as well, so keep that in mind. Another thing, businesses. So if you have businesses having deliveries and all of that, doesn't need to spend as much. Lower cost of operation. So that would also help businesses invest more and increase aggregate demand. More affordable childcare. So this affects unemployment. So the goal of full employment. So let's say childcare is more affordable. These parents are going to be more willing to put their kids in childcare and go back to work. So initially, it could actually increase unemployment because you've now got more parents actively seeking work. But over time, it would actually achieve our goal of full employment as the people coming back to work are efficient, they are willing, and they are able to work. Energy price relief. So this is the more recent one. So this is this year's budget. Energy price relief. So it's basically subsidizing energy. So the prices of energy, so gas, electricity, and so on, for businesses and households. So for households, this would increase consumer spending because they now have less money that they need to spend on electricity, energy. So they have more money to spend elsewhere. Small businesses, this could increase their willingness to invest in their business, buy more machinery, buy more capital, hire more labor, and be more productive because they don't have as many energy costs. Okay, responsible, sustainable income support. So this is when you, It's basically like welfare, so income support payments. If we're increasing that support, it could have stronger economic growth because people are spending more, there's more consumer spending, higher aggregate demand, and I guess more growth as a result of that. It could affect inflation, so it could increase inflation because of higher spending, so cost push inflation. Another thing, demand pull inflation. So it would increase demand pull inflation. Another thing it could do is it could affect unemployment. So if we have people receiving higher welfare payments because they're unemployed, they might be less discouraged to actually go back to work. But again, that's not a very strong argument. So I think this is most linked to strong and sustainable economic growth. That's number one. And then perhaps inflation. Building more homes. So this one is infrastructure. So that infrastructure always increases aggregate demand. So if we build more homes, greater supply of homes means that consumers don't have to spend as much on buying property, buying their homes. And that could mean that they have more money elsewhere so that they can spend somewhere else in the economy. So like we said before, cheaper childcare, enhanced paid parental leave. Again, same thing as before, more parents going back to work. More livable suburbs. So this will directly affect non-material living standards. So the infrastructure, aggregate demand. So you've got more people employed to build all these stuff, to plan it, to build it, to organize it. You have more jobs automatically. So immediately it will decrease that level of unemployment in the economies. More people are hired, and that increases economic growth. And there's a lot more policies, so you just need to pick a few that you can link to the goals. So maybe one policy for each of the goals. But remember, some policies are related to multiple of the goals, so that's just something to keep in mind. Okay, that's it for the budgetary policy. We are about halfway through the content, so feel free to pause the video now, take a break. Because it's recorded, obviously I'm not going to take a break now, but I'd encourage you to just pause, take a break, walk around, drink some water, and then come back.